Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is titled, Is it the End for Value Investing? Value investing has had a really bad decade. Over the last 10 years, the MSCI World Value Index has done 50% worse than the MSCI World Index. A decade is a long time to wait for things to get better in the investment world. Coincidentally, Charlie Munger, who was Warren Buffett's partner at Berkshire Hathaway, sadly passed this week. That duo are the most famous value investors of all time, and we'll discuss their approach in the podcast and their 20-year underperformance. Is value investing doing something wrong? Our answer is yes, and we'll explain why in the podcast. Just a reminder, the information in this podcast is general advice only, and is not intended to be specific to your personal financial situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. Today, as always, we have Nucleus Wealth's Chief Investment Officer and co-founder, Damien Klassen. Welcome back.
Hey, Sam.
My name's Sam Kerr. I'm the head of advice at Nucleus Wealth. The themes discussed in this podcast are a reflection of our thinking, which we implement across all our active portfolios. You can find out more about our offering in the description notes below. As many of you know, the show is recorded live every Thursday at 12:30 Australian Eastern Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. Podcast is also available on all other major podcast platforms, so feel free to tune in there if you prefer. Until the end of the year, we are still offering a free, no-obligation super review. We'll give you a super health checkup. We'll check the fees, make sure you're not paying too much in fees, make sure you're invested appropriately, and then also make sure you're aware of any tax-saving opportunities on offer. So you can book in at nucleuswealth.com/contact for that as well. So those are the formalities out of the way. Damo, over to you to get the ball rolling.
Yeah, so value investing today. So, we just want to do a quick shout out, I guess, for Charlie Munger, who's sort of Warren Buffett's partner, died during the week and very much thought of as one of the key value investing pioneers and titans, I guess, of the value investing sector. So I really just want to talk about this whole idea of value and what I would term superficial value versus sort of real value, and talk about what the issues are and it's had a really bad performance as a factor, and I just want to sort of dig into what's sort of driving that and how a lot of the bad performance has been about the superficial value really doing poorly. But I sort of need to work my way through into sort of what is the value, what's gone wrong, what the measurement errors are, and then how do you fix that, and what should you be looking for in terms of value. So I'll start with the how bad it's been, and we're coming up to 10 years worth of bad performance now for value. Now, value is a strategy which in the past has been has delivered intermittent returns. And so what I mean by that is a lot of the other strategies, quantitative strategies you try and invest in, where you're looking at so whether it's growth at a reasonable price, or you're looking at high quality stocks or momentum stocks or all these other factors, have got relatively consistent returns. Yeah, you'll have a bad year here and there, but you don't tend to go through sort of long droughts before you get to the feast. So you don't go through the famines and the feasts and stuff like that. Whereas value investing traditionally has been very much like that, is that you have a lot of years or several years of underperformance, and then you have these cracking years where you make it all back. And so the issue is we're now up to a decade of underperformance for value. And while there's sort of this, this whole, trust me, it's all going to come good, it's a good strategy, over the last decade, I've got a chart here just sort of showing the gross returns in US dollars for the MSCI World versus the MSCI Value. And if you go back a decade, they both sort of started at 200. The MSCI World is up at 420. So it's sort of more than doubled. And the MSCI World is at 325. So it's up about 50%. So you've underperformed by about 50% by investing in value over a decade, and that's stretching a friendship, if you know what I mean. Like you have to start questioning pervasive underperformance in that way. Is there something wrong with value itself? Are you measuring it wrong? All these other factors sort of come into play, and we'll talk about that as we go. So the first, I just wanted to take a really big picture look at quantitative factors first. Just a very, very quick one. It won't be a short diversion, I promise. But there's basically a bunch of different factors you can try and say, I want to buy these types of stocks, and they give you a certain type of performance. Now, the 5 sort of main ones that people try and get are momentum, which is I'm buying stocks that are going up and I'm selling stocks that are going down. Low volatility, so basically I'm buying stocks that where the share price is not particularly volatile, and so they tend to be lower risk stocks, and they actually do tend to give you better performance over the long term as well. Then I'm looking for growth stocks, so stocks that are growing strongly. I'm looking for quality stocks, so stocks that have big margins, are making good returns on equity and things like that. And then finally, I've got this idea of buying cheaper stocks. And so each of these factors can sort of be broken up, and you find particular stocks that sort of do one or the other. And some of them are exclusionary, like it's hard to find ones that fit everything. But the thing I really wanted to highlight is that of those 5 factors, value is very different in that it is making an assumption about mean reversion. So all these other factors are basically, you're making an assumption about not mean reverting. So I'm saying if I buy a high quality stock, so a stock that's got high margins and is earning good returns on equity, it invests money and it gets a good return on that investment. I'm basically making a bet that that's going to keep going. So that's the situation right now, and I'm going to bet that company, because it's high quality today, will continue to be high quality going forward. Or if the quality starts to fade, I can have a look at it and I can switch that out. Same with growth, buying a growth stock because it's growing today and I think it's going to keep growing tomorrow. Momentum, low volatility, same type of thing. Value is different. Value, what he's saying is, I'm buying a stock because it's cheap and I think it's not going to be as cheap in the future. And so there is it's a different assumption. And that's partly what comes back to those returns I was talking about earlier, in that value stocks tend to give you a couple of years of poor performance. And then, well, in history, if I exclude the last 10 years, value stocks have tended to give you poor performance in most years, and then just had some cracking years where you get all these great returns back from investing in value stocks. And it's something like the tech wreck. We had this massive boom where all these tech stocks went ballistic, and if you're investing in value, you underperformed the market as it rose. And then at the other side of it, you had this fantastic value trade where you made all this money from the value. And that's sort of that's the pitch you get when you go to invest in value. I've got this sort of analogy I use. It's like a religion. Like value is treated like religion, and partly because of this. So because of the nature of it. So if you look back at sort of how religions come about, and there's some people that sort of put forward this theory that if you're a farmer of a seasonal crop, so you're a farmer somewhere in Europe of wheat or whatever it is, back in hundreds of years ago, you can put a lot of work in to doing your field, and but the issue is you're very dependent upon the weather. You might get like a 5 or a 10% better yield than the guy next door to you that doesn't put all the work in. But actually, if it's a great weather year, then you're going to do well. You're going to do really well, and the guy next to you is going to do pretty well as well, even though they didn't put a lot of work in. The flip side is when it goes in the bad years, you put all this work in, and you still perform. Your farm still gives you a really bad performance because of the weather. And so, the argument is, well, that's why we ended up with a lot of these religions, because it was the idea that, I just need to keep preaching to people that, trust in God and trust in doing hard work, and everything will come good. And you're sort of praying to this higher power that's going to deliver the performance of your crops. And value investing's got a little bit the same in terms of you go through these, because you go through multiple years of poor performance. You need that reassurance from the people who are doing this that, hey, value investing is working. It's great. You buy cheap stocks. They're always, history says it's going to work. Just stick with me. Everything's going to be fine. And it's that belief part that needs to keep coming. And you get the profits as well. So, you get I'm the one true prophet of the words of Warren Buffett or Ben Graham or whoever your chosen god of value investing is, and I will interpret those for you and buy my newsletter for $1,000 a month, and you make all this money from it. And because of the nature of it, it's also quite hard to judge value funds, because let's say I'm looking for a good value fund, because I've got a few different funds. I'm trying to invest in my portfolio, and I'm saying, I want a few quality ones, and I'll get some small caps to chase that. And I want to have a value fund so that if everything else goes badly, this value fund will outperform. It's hard to judge the performance of them, because you're basically saying, I'm buying this fund because the 1 year in 3 or the 1 year in 5 where everything else is going to go the other way and my value stocks are going to outperform, then I'm going to rely on this fund to get me the returns, is that you don't have very many data points, because you're basically relying on, I've got to wait for that 1 year in 5 to actually judge whether these guys did it right. And sometimes those value funds, as they go through their dark periods, they'll have a bit of style drift. They'll be like, well, yeah, we invest in cheap stocks, and then after 3 or 4 years of cheap stocks not doing particularly well, they've started to drift into, oh, well, maybe we'll buy a few stocks that are, we can squeeze into a cheap definition, but maybe they don't actually fit it. And so the year that actually comes good, if your value fund manager is one of those guys that's sort of had some style drift, maybe they actually miss out on that good year because they've let themselves drift over that time frame. So value funds themselves, are a religious experience. It's sort of similar in that perspective. The other thing I want to note is that it's been a really wild ride for value funds. So I've got a chart up showing, now this is S&P, this is S&P 500. I'll talk through it for anyone who's listening to the podcast and not seeing it on screen, because it is a little bit confusing on the screen as well. I've got all these different style factors, which are saying, well, if I basically bought the top quintile of this, so the top 20%, and I went short the worst 20%, what would the difference in returns be over this last decade? And so the idea is, so I'm buying, so in the value sector, I'm saying I'm going to buy all the cheapest stocks and I'm going to sell all the most expensive stocks. What would the difference in returns be? So it's been all over the place. So in 2015, you would have done minus 17% on this strategy, versus price momentum, which did positive 23%. So you're sort of 40% below the best strategy in that year. In the next year, you were sort of plus 11%, and some of these others were down a little bit. Then you sort of skip forward a few years. You had another year where you were down 8%, and where every other factor just about was sort of up almost 10%. Another year, you're down 26%. You had a fantastic 2022. You did plus 30%, but then so far you've given all that back a plus more in 2023. And so it's just been this, and actually, that year 2022, you're plus 30% on this value one, but the volatility was minus 35%. So there's like a 70% swing in the difference between those two factors. And so it's just been this ride for valuation, which it's been feast or famine. And so it might have been great that you had this fantastic 2022 year, but if you didn't sell those stocks in 2022, you've given it all back in this year. So whereas you look at some of the other factors within that, they're a lot steadier in terms of the returns. You get the more consistent returns, and over this 10-year period, say price momentum or analyst expectations, which is sort of one of the ones we sort of track quite a lot, would have given you like a 4% outperformance if you're just buying stocks where analyst expectations are being revised upwards. And whereas valuation, you've lost money by buying the cheapest stocks on this in aggregate.
And Damo, just a quick question in regards to like comparison to say the MSCI World Index. How have maybe price momentum and analyst expectations, how have they compared?
They've tended to outperform. So you get the quality performances have been, quality and growth has been good. I think, well, you got to pick your period, but over the last 10 years, both quality and growth have been much better performers than value. Yeah, I think the volatility index. I was going to say, I think in aggregate has underperformed. I just have to double check. The last year's been like a cracking low volatility index year, and so maybe that's up to even, but I think it still has underperformed over that time period.
Okay, great.
If you jump to, I've got another split here where I'm looking at the last 5 years and just doing a split by sector, because sometimes when you look at these, you're like, well, actually the sectors, if I had bought this within sectors, I would have done it right. It's actually the sector call that's undone it, but that hasn't been the case, and so I've got a chart that's sort of showing up that, of the sort of 11 big GIC sectors, most of them were six of them gave you some pretty negative performance. One of them was sort of closer to zero. And of the good ones, they're all relatively close to zero, except for maybe one, the healthcare sector. And also, it's a little bit inside baseball. But when I look through the way these occur, like good quantitative factors tend to be relatively consistent. So you go, well, if I had bought the best version of this, I would have done whatever performance, whether it's negative or positive, and then the second best is like. And then third best, it all comes in order. So like if the worst was a 1% outperformance and the best was a 1% underperformance, then a good quantitative factor should be sort of roughly in line when you look at those coming through. And whereas when you look at that for a lot of these value factors, it's been a bit of a random scatter, which is sort of saying, well, it's not really a consistent measure. So that's sort of some of the problems. I do have solutions, but let me go to you first, Sam, and we'll come back.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. Just one more quick thing. We just want to ask you for a simple favor. We want to spread the message about transparency, innovation, and integrity in investing. At Nucleus Wealth, we live and breathe these values. We would love it if you can help us spread that message, and subscribing to our channel will help us do that. We would be most grateful if you can hit the like and subscribe button now.
Right. So I think a lot of the issues I have with value is the way it's constructed, and I think that's a lot of that comes back to why we've seen some of this underperformance, and I'll sort of prove that in some of these coming charts. But I sort of have to detour a little bit to sort of let you know how the most used value indexes get constructed. Now, the most used ones are from MSCI, and they have this. I've got a chart up sort of showing how they put it together. But they have basically these two axes which they look at companies on. One is a growth axis where they say, okay, is this company growing strongly or not? And the other one's a value axis, which is this company cheap or not? And I guess what they're trying to say within this is companies sort of fit into one of these different categories, in that this is a company which is not cheap and it's growing, and so therefore it's thought of as a growth company. Here's another company, or there's companies that are cheap and are not growing, and so therefore they're treated as a value stock. And then you've got the two sort of other quadrants where it's like, well, it might be a bit value and a bit growth, and we'll try and assess a certain amount of it to be that. But the idea is that effectively what you're doing is they're splitting the market up and saying, here's a growth part of the market, here's a value part of the market, and then here's the other part which sort of doesn't really fit to either. And what they're doing then is saying, okay, well, if we take that value part of the market and put those stocks into an index, how do they actually perform? Now, as a concept, that's, I don't have a major problem with the concept. A lot of it's in the execution of how they're actually doing it. So what they rely on in terms of how they put it together is a lot on book value. So it's the accounting value of how much the assets are worth, the net assets of the company, and I'll talk about the problems we have with that. They don't have any cash flow measures in there. There's been a lot of changes in accounting standards. They don't do a lot on forward earnings, and the forward earnings numbers they do look at, I'm a little bit suspect about. They do some weird growth calculations, and they've got these some quite, I would call it concerning statistical issues in terms of how they put it together. So I'll run that through in a bit of detail. But so on the so basically on the value side, what they're trying to do is they're trying to say, is this book cheap on a price to book value? So what do the accountants say this thing's worth, and how does that look versus the market value? And this was a big measure that Ben Graham spoke about and sort of documented in the maybe 1950s, I feel like 1950s or 60s. There's a lot of research around this book value about how it's it's positive. It gives you a positive return over long periods of time and things like that. The issue I have is that accounting standards have changed, and book value from the 1950s is not the same as book value from the anything into the 2000s. So 15, 20 years ago, there was some pretty significant changes in terms of the way we account for book value. And that has meant that it's not consistent. And so if you had I'll explain what the change is that when you acquire a company, when one company acquires another company, so company A acquires company B, and say they spend $5 billion acquiring company B. And company B is worth, so it's got a book value of $3 billion. So that the accounting transactions are basically $5 billion out the door. We've got $3 billion of assets that we can account for, and we've got $2 billion of this asset that we can't account for, which is the goodwill of this other asset. And so that goodwill comes into my balance sheet as $5 billion out, $3 billion of net assets in, and $2 billion of this goodwill to make the whole thing balance. And what used to happen was that goodwill could be written up or written down by the management. So the management might say, actually, 3 or 4 years later, you go into a massive downturn, and they're like, oh, this company we bought for $5 billion, that division's performing really badly. We're going to write and we've got $2 billion worth of goodwill. We're going to write that down, and so it's no longer worth $2 billion. It's worth $500 million. And then, though, if it bounced back the next year or the year after, the board could turn around and go, well, actually, that was probably a mistake. We will put it back to the $2 billion. Whereas nowadays, that's not the case. Nowadays, you basically, once it's written down, that's it. You've written it down and you're done. So you have a bad year and you decide to write down those assets, and then they all recover. There's no writing them back up again. And so there's this bias towards assets being written down and never bouncing back. And what that means is that the book values we're looking at are not the same book values that you would have got for the other companies. And the other issues we've been through a lot of changes in terms of the way companies structure themselves. So a lot more outsourcing, a lot more services companies, and all these means that book value is not as important as it used to be. And the outsourcing side, as an example, if you took a company like a Boeing, 20, 30 years ago, maybe even longer, they did most of the manufacturing themselves. And so they did have these quite big factories and a lot of book value because they would have to buy a factory, and then that factory would sort of depreciate over time, and they'd be producing whatever parts for it. Whereas over time, they'd started outsourcing more and more of it, doing a lot more of the design work themselves and a lot less of the actual manufacturing. And so what that's meant is, for a lot of listed companies, and that manufacturing often gets done by smaller companies, which are more private or less likely to be listed. And so what that's meant is Boeing's balance sheet. They've now got less net assets because most of their assets are now their intellectual property about the plane designs and getting engineers that can design new planes and that type of thing. And so so this book value has been and that's been one of the factors that's been a real poor performance. The MSCI indexes don't have any cash flow measures. Now, for us, cash flow is our most important measure. Actually checking what is genuinely coming in. For companies that can always spin a good story about what you should ignore and what you should include and all these things and write-ups and write-downs and all these things like that. But cash it's much harder to lie with cash. Still possible, but much harder to lie with cash than what it is to with profits. MSCI don't have any cash flow measures on their value, and I don't think that, or on the growth. They rely on when you start looking at partly why they assign some companies as growth companies and not as value companies. I've got a lot of problems about how they do that as well. They rely on some analyst numbers. And again, it's a little bit inside baseball, but they rely on some analyst numbers that this long-term growth figure that gets uploaded into systems. Now, my experience of analysts is analysts don't give a stuff about this long-term growth figure. It's a nobody ever looks at it except for some of these some of the quant funds and people like that. The people they're dealing with day to day are more worried about what's next quarter's earnings going to be, what's next year's earnings going to be, maybe 2 or 3 years out. There's not a lot of people care about what the analysts are doing for that number. And so the analysts upload that number because they've been asked to. It's in a template, but they don't actually focus too much on that. And that's one of the key figures that goes into whether a stock is a growth stock or not. The MSCI then run regressions over prior growth numbers for stocks, and when they do, they use 5-period regressions. So anyone who's done any sort of statistical analysis, if you're running a statistics over 5 samples, so 5 individual data points, you'll know you're going to get some pretty wild swings around, and one funny data point can easily send you the wrong way on that type of thing. So there's some serious problems I have about the way they put these indexes together for that, and then say that okay, these must be value stocks. So what that tends to mean is you do tend to get a concentration of energy stocks, a concentration of banking stocks in the official value portfolios. So what do we do differently? How should you do it? Well, cash flow is the big one. You should be looking at cash flow. That's very important on both growth and on valuation. Looking more at earnings and trying to delve into what's happening on the earnings side. This whole idea of deep value and book value, we rate as a very low factor in our models, and we do try and get a bit deeper inside the numbers in terms of trying actually to get back to more the factors that would have worked in the past. So looking more at the unwritten down values of some of these, and what we'll often look at is replacement value for some of these assets as opposed to book value, which we feel gives a better indication for some of these factors. And then what are shareholders actually genuinely getting out of this in terms of I guess from my perspective, you can look at some of the factors that the MSCI put into their value, into their growth factor. You can get the wrong impression from the growth. So what I guess I'm saying by that is that if I have a company that's grown its earnings per share by 10%, but it's required some huge increase in the amount of debt that they've gone from a lightly geared company to a very heavily geared company, then effectively they've just gone out and bought a lot of that growth, and that's not a sustainable way of growing the company. So yeah, you can do that a couple of times, but at a certain point that runs out, and it actually increases the risk of the company a lot as well, because now I've got this much bigger debt burden. And so you need to sort of factor off what companies are doing on the capital front. And so we're quite happy to have, if we look at 2 companies and they're both growing at the same rate, one of them's ripping capital out of the business and paying it all back to shareholders, and the other one's putting lots of capital into the business, then we'll rate those 2 companies very differently, even though they're even though they might look the same on terms of growth basis or a value basis. And so that's sort of, some of the thoughts. And if you dig into those same factors, and so I've got another chart showing up the breakdown over the last decade of these same factors that I was showing. Sorry, the breakdown of some of the individual components of that value index I was showing before, the one that was showing the wild changes between one year and the next, is if you look at the top one, which is free cash flow to price, and this is an historical measure, but I think there's actually some future stuff you can do and a mixture of some of the future stuff that actually gives you even better results, is you can see the returns there have actually been pretty good. And when you've had bad years, you're sort of like saying, okay, I was down 5% rather than down 30%. And so you can see what I'm saying in that if you're using a value mechanism, as MSCI is, that doesn't take into account free cash flow, then you've basically excluded the best performer for the last 10 years, and you've relied on these other methods, which have got what I think are some relatively serious flaws in them. So being more discerning about what you're using and is one way to sort of get around this. We'll jump to another message, and then I'll come back and I want to talk more about some other ways that you can the value looks better.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. So, Damien, we've had a comment come through from Wolfgang, and they're saying they think there's no actual method for value investing, and they're saying they've had success just treating it as an invitation to learn and be creative with investing analysis and ideas. Yeah, I mean, do you have any sort of thoughts and comments around that? Because it does work well sometimes, right?
Absolutely, and I absolutely think it's a key part of what in terms of how we invest, and I do think there's he's right in that value investing itself doesn't have this definition. MSCI, who acts as sort of like the benchmark for value funds, they do have some quite strict definitions. And what I'm saying is, if you look at their definitions, that's why value investing looks so poor, because it's poorly defined in terms of the way MSCI is doing it. But the whole idea that I should look for stocks that are cheaper than other stocks is, for the same quality of stock or the same growth rate or something like that, that I should be predisposed to buying the cheaper one. Absolutely, completely on board with that. And that's what I think I'm trying to get to in a lot of this presentation is how do you look at value? How do you look at value investing? Because the overall concept is I would like to buy cheaper stuff rather than more expensive stuff. Should be a sort of, I don't know, a building block of your entire investing. So it seems weird to say that hasn't been working.
Yeah, excellent. And I guess that's a good segue into the next section as well.
Yeah, that's right. So I think I've got the two parts I have spoken about, saying, look, valuation is a tool; it's not a religion. Don't treat this as I just have to buy value stocks and trust in the value gods to deliver me performance. Use it as a tool as part of other things. You need to make sure you're not falling into this mistake of when accounting standards change, you're actually updating. And there was another accounting change, it must have been 2 or 3 years ago now, with some with the way leases are being treated, and that has made some sort of for some companies, it's made some sort of groundbreaking and seismic changes to their balance sheets, which you need to make sure that you're treating it the right way as well. But the most important point is that the value is a trade-off. You need to have another axis. So you're not buying something just because it's cheap. You're buying something because it's cheap relative to something else, some other axis. Now, we use quality. But just as likely you can use growth or something else as momentum, or pick whatever it is. You need to have another axis. What do I mean by this? So let me use the quality example. If you're going to go out and buy a car, you're not going to buy the cheapest possible car. You're probably not. I'm guessing you're not going to buy the cheapest possible car, because the cheapest possible car you can buy probably doesn't run. You can buy it, yep, but it's going to sit there in your garage and it's spare parts. You can buy one for, I don't know, whatever, $100, $200. It's worth the scrap metal value of the car. So it's not going to give you something that works. And so then you go, well, let me spend a bit more money though. Not heaps, but I'll add another $5,000 to the price. Okay, now I've got a car that probably runs. And probably runs a fair bit of the time. It's probably not going to be that reliable, or it's going to be old, or it's going to have a lot of kilometers on it, or whatever it is. But I have a car, okay, and I've spent a bit more money, and I've got something a bit better. Now I go again. I spend another $5,000 on that thing. Now I've got something a bit later. It probably runs a bit better, a bit smoother. It's probably a bit nicer to drive, and more safety features or whatever it is. I've probably stepped up a fair bit. I've got a fair bit of quality for that increase in price. But there's decreasing returns. As you keep going up and you go, okay, so you get to, say, a BMW, and so I own a BMW 3 Series, and I'm like, okay, now I want to go to a BMW 7 Series. Now, that's probably going to cost me $50,000 more. So I was talking about doing $5,000 increments at the start and making a big difference in quality. Look, the difference between a 3 Series and a 7 Series in terms of getting me places, in terms of reliability, all that type of stuff is not that much, really. Yes, there's an improvement on some certain things, but they're pretty marginal, and it's more about wants rather than needs. And so that extra $50,000 I'm going to spend doesn't really provide me a lot of extra functionality in terms of the car. And then if I go to whatever it is, some rare car, or Bugatti or a Ferrari, and I've spent another $500,000 on getting me some supercar, again, the actual act of getting from one location to another location, it's probably going to be worse actually on those ones, because I'm like, I'm not parking this thing on the street. I need to get that away where no one's going to touch it. No, whatever it is, and servicing costs and whatever. I guess what I'm saying is there's not a lot of extra, or the extra quality you're getting is very, very marginal for really big jumps in price. And so what I'm trying to get to is there's this trade-off for everyone to say, well, where does that factor come in where it's like, okay, I'm getting a certain amount of quality for a price that I want to pay for it. And that's how you should be thinking about your stocks as well, is that, this might be a fantastic stock, but if it's priced at a price that's just unbelievably expensive, then it's not going to give me a good return over time, despite the fact the actual earnings of that stock and the fundamental performance of that stock might be fantastic. But if I've overpaid so much for it, that I'm just not going to get an economic return on it. And that's where, for me, is about trying to trade that quality versus value. If I can find really top quality stocks at an average price, bam, they're in the portfolio. And I want to hold those on until they get so expensive that I'm like, okay, that's too far. Then if I'm buying an average quality stock, now it's about saying I've got an average quality stock that's really cheap. But if it starts to get up in value, okay, it's straight back out the door. I don't need to hold on to that thing forever. So I bought it because it's cheap. Time to sell off. So yes, so get another axis. Could be growth. There's a lot of people who run sort of what's called growth at a reasonable price. I think quality is a good one. There's a lot of other axes you can use in terms of some of these other momentums and things like that. But get yourself another axis. And value itself, keep remembering that value is a bet on that mean reversion. It's different to others. There's a saying out there that there's no bad assets, there's only bad prices, and I do think that's right. So what that's effectively saying is, you pick a company, there is a right price and a wrong price for any company. Now, there might be a company that's going to be a net liability to you, but maybe somebody's going to pay you to take that away. So, there's say you have a mine that's going to have, it's a mine, it's about to close up, but it's going to cost, $100 million in remediation costs. Is saying, well, if someone's going to pay me $300 million to buy that mine, and then I have to spend $100 million on remediation costs, then maybe that's a good outcome. But if I'm going to buy that company for $1, that's probably a terrible outcome. I'm buying it for $1, and then I have to turn around and spend $100 million shutting this thing down. So the idea that there's no bad assets, only bad prices, and this idea that superficial value is not the same as value. I've got a chart up just sort of showing that what we do in terms of that trade-off between quality and value. So we stick them on different axes. And basically I want to say that, I'll let stocks move up and down that axis depending upon that they often move based on the value. So I've got the value on the x-axis, and so things will move back and forth based on the value. And so if I buy, as I was speaking before, if I buy an sort of an average quality stock that's really cheap, and then it becomes just cheap, then I'm like, okay, it's out the door, and I'll go find another average stock. Whereas if I find a really high quality stock that's average value, yeah, I can carry that until it's expensive, and maybe even I'll add one really expensive to it. But if it ends up being really, really expensive, now it's time to start tipping that out, because those high quality stocks are the ones that tend to give you those consistent returns. And with that, I'll jump back to Charlie Munger and Warren Buffett in particular. So people hold them out to be value investors, and Ben Graham as well. People hold these guys out to be value investors, and they are to a certain extent, but they're just as much quality investors. And if you read any of the stuff they write, it is all about margin of safety. It is all about having an economic moat, and these other factors, which are all about quality factors. So saying, if you look at some of their biggest holdings over a long period of time, something like a Coca-Cola, there's long periods where you wouldn't describe Coca-Cola as a value stock. It's been a high quality stock that's got good returns on its assets and good returns on its reinvestment. And the Warren Buffett and Charlie Munger basically looked at it and said, okay, we've managed to buy a really high quality stock at an average price. We'll take that deal, and we'll take that deal every time. And so, for them, it's all about getting that trade-off between quality, and that's how we like to think of it as well. Now, just sort of given Charlie Munger has passed this week, I thought it's well worth sort of jumping in on some of his sayings about investing and learning in particular that I think for me certainly ring true, is that the world is full of foolish gamblers, and they won't do so well as patient investors. And I think the idea is that this happens on a shorter term time scale, and he speaks about the character to sit with cash and do nothing, and he sort of didn't get to where he's to where he is by going after mediocre opportunities. And I think that comes back to that whole idea about people feel as if I'm sitting on this cash, it's burning a hole in my pocket, I've got to get out and invest it straight away, versus actually saying, no, let's just wait, be patient, wait for the right opportunities, and then sort of move into those when those opportunities come up. He talks about one of the ones about the investment sectors, the investment management that I like, and particularly if you are going to be buying investment funds from people, I think this is a good buyer beware. He speaks about the idiocy in investment management, and he best illustrates it by a story about the guy who sold fishing tackle. And so Charlie Munger asks this guy, he says, "My God, this fishing tackle, they're purple and green. Do the fish really take these lures?" And the guy selling it says to him, "Mister, I don't sell to the fish." And that's I think his anachronism back to the investment management is what sells to investors may not be the same as what sells to is what actually works. And I think there's a certain part of that, particularly the value investing part, which relates back to that, is if you're just going pure value investing, particularly on some of the MSCI stuff, that you might be running risks you don't understand. And the other thing Charlie was very big on is learning. He spoke often about the people who weren't the smartest or not even the most diligent, but the people who actually were out learning every day, and they're the ones who actually do well in the long run. And that as a great investor, you got to keep learning. And they were very big on this. He was 99 and still doing investment, and Warren Buffett's in his 90s and still out doing lots of investing. And the whole idea that the world changes, you've got to change, and not sort of getting stuck in your ways. So we'd like to sort of, a bit of a shout out to Charlie Munger, and certainly who provided a lot for value investing. But I think make sure you're learning the right lessons, I think, from what he was talking about. And so we might go to the question of the week, and then I want to talk about when does value investing go well and when doesn't it go well? When should you have it in your portfolio or not?
Excellent. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, will value investing make a comeback? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And now back to you, Damo, for the investment implications.
Mm. Yeah. So this is the big question is, so you've got all these different factors, I spoke about growth and momentum and all these other things. And one of these is value. When do I want to own the cheapest stocks? Now, I need to start by what the cheapest stocks tend to be. Is if I'm buying the cheapest stocks, they tend to be stocks that don't have a lot of market power. They tend to be stocks that are relatively reliant upon what's happening in the broader macroeconomic economy, because they can't put their prices up at the same rate. So let me take car companies as a great example. The car companies are very low PE stocks. You can buy most car companies for single digit PEs. They might be like 5 or 5 to 10 times your earnings, whereas the market's closer to 20 times its earnings. And so these stocks are cheap, but they don't have a lot of market pricing power. And when the competitors, a bunch of cheap cars come in from China, you got to cut your prices, because otherwise you're just not going to sell the same amount of cars. And so there's a lot of other companies that sort of sit into that same bucket, whether it's sort of chemical industries or other more commodity type goods. And so there is a time in the cycle to buy these ones, and there is a time when these things are going to outperform. So generally it's when what we're seeing is what I call a growth catch-up. You're seeing quite strong growth. You're seeing inflation rising, because what it means is, and we've seen that over the last year or two, in that when inflation's rising, all companies get to put their prices up. So everyone else is putting prices up. These guys can actually go, well, I can point to higher transport costs or higher fuel costs or whatever it is, and they can actually finally put through a price rise without their customers just jumping to their competitor. And so it tends to be sort of at the start or the middle of an inventory cycle. So as inventories are still building up, and often it's with more fiscal expenditure. So governments are out spending more money. That's when you want to be buying these value stocks. When do you want to sell them? Well, you want to sell them when growth is slowing. You want to sell them when inflation is moderating. So they managed to get these price rises through because everyone was doing it, but now nobody's actually now the extra supplies come on. So take the car industry. They've all managed to jack their prices because nobody could produce enough cars fast enough. Now there's big price wars going on in China. All these new factories are coming on, producing all these extra chips. They're starting to, volumes are flying. They're starting to see inventories building up at some of the places they're trying to sell. You've got to the other side of this, and we're starting to see price falls because of that. So growth slowing, inflation moderating, the end of that inventory cycle. So you've seen inventories build up. Now they're going to have to just start declining, and that's probably where we are in some of these, and less fiscal expenditure. So governments are spending less or trying to pull back on their fiscal expenditure. And I think you can, for me, you can pretty much tick all those boxes. And so within the portfolios that we run, we try and move people back and forth between those. Within the stocks we're buying, sometimes we'll be predisposed to buying. We just want a portfolio full of high quality stocks that we can get for the best price we can get for them. Other times we might be saying, actually, no, we actually do want a lot of value stocks because they're at the right point of the cycle, and they're the ones that are actually going to perform better than some of the quality stocks. This is not that time. The time for us is to be filling up your portfolio with these higher quality stocks that can maintain their margins, because we do think we're going to this period where these value stocks are going to get squeezed. And so, now is not the time to be loading up on value.
Excellent. Thanks for that, Damo. And I just want to add as well, we do have a tilt towards value stocks. So across all the portfolios that we offer, you can tilt towards value, for example. We have some other quant factors. So there's quality, there's growth, there's also defensive stocks. And you can utilize these across all the portfolios, like I mentioned. And we also have some new tilts and screens available. So with a screen, we can screen out any stocks that pay less than a 1% dividend. And with the tilts, you can add in higher yielding stocks there as well. So some of the new innovations we've come up with there. So feel free to check them out at nucleuswealth.com. Thanks for today, Damo. I'm sure, maybe value is going to have its day in the sun again. And we will continue to report on that.
It absolutely will one day. Yes.
Yeah. Okay, excellent. So yeah, look forward to the next episode when that happens. Who knows? No one knows. So yeah, we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. So from myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.